This is Justin speaking. We'll go ahead and begin tonight's webinar. And tonight's webinar is understanding how to build your credit moving forward. And this is workshop number 4 out of 4 workshops. It is a series that we've hosted this month, and I've enjoyed doing so all month long. Thank you to the Wells Fargo Foundation. The platform we're using today is Zoom. It offers great accessibility, but it's best if viewed via a computer or a laptop or a desktop, and is not an optimal experience on a cell phone or a mobile phone. So we do recommend that you use a computer or a laptop. We do have sound on. There is a voice interpreter for tonight. We have good interpreters here. So if you'd like to watch the captions while I sign, go ahead and click on the icon button at the bottom of the Zoom software and select Show Subtitle. You'll be able to see that. Folks, if you experience any issues, please type those into the chat box. Again, if you look down towards the bottom of the Zoom window, you'll see an icon that says chat. Also, for viewing tonight's webinar, we will be using a share screen feature, which means that the screen will show a slide to one side. That slide is adjustable so that you can adjust either the size of the slides or the size of the video squares. As you can see in the example being shown on the screen, there's 2 lines in the middle, and you can just click on those and slide them either way. If you'd rather see me smaller when I sign, or if you'd rather see me bigger when I sign, you can use that control feature to slide the sliders back and forth and resize, again, either the video screens or the presentation. If you'd rather have the PowerPoint larger, then slide in the direction that makes it smaller. However, that will reduce the size of the video windows. Just keep that in mind. Also, please make sure you're using the most recently updated version of Zoom. And if you experience any issues, please go ahead and type your questions into the chat box. We have a wonderful team here behind the scenes to provide you support with any issues you might experience. Now, if you see a question or would like to ask a question, you can do that in the Q&A box. Again, if you look towards the bottom of the Zoom software, you will see a Q&A icon. And I think it's about the 5th one over, right before the closed captions icon. And so if you have any comments you'd like to make, not relating to the Q&A, please use the chat box. You'll see that icon also at the bottom of the software, right next to or right before the screen share icon, which is in green. As we work our way through tonight and you have a question you'd like to ask, please type that into the Q&A box. I will be responding to those at the end of tonight, towards the end of tonight. Also, if you're in the audience and you see a question asked that you like in particular, you can upvote it. You can click you like that question. And if it was one of the last questions asked, for example, and more people upvote the question, then it will reprioritize the question so that it can be asked first if everyone upvotes it. Also, we'd like to express some gratitude to CSD Learns for being able to put together tonight's webinar and having me here, and also providing the rich experience and the rich information that we're sharing with the community. And I do hope, folks, that you apply this in your individual life, in your personal life, and in your business life. And along with that gratitude to CSD Learns, we'd also like to recognize and thank the Wells Fargo Foundation for providing the funding. So thank you so much. Folks, are you ready for tonight? Are we ready to ride? I do realize I've been talking and I haven't introduced myself. I am Justin Folk. I'm Vice President of Finance at Folk Williams Financial Management, and we're based in the Los Angeles, California area. We have 2 social media accounts. One on Facebook is at Folk Williams Financial, and on Instagram at Folks Williams. And we do post regularly on both. The firm I work for is a family business, which was started in 1958. And what I share is our experience that we've had over the years. So if you have any questions that having to do with your personal finance issues, you can go ahead and reach out to me at those social media accounts. And remember, keep in mind, we do post often and regularly. Our workshop series has focused this month on understanding how to build your credit as an individual and for your business. The goal is to help you prepare and plan your credit successes. So today's topic is moving forward. This next hour, we'll be talking about the tips and resources that we've shared, and you'll see in the next slide that our goals for tonight are, again, basically to review some topics that we have covered in our 3 prior workshops along the series. So we will be reiterating some of the information in order to help you keep that in mind and keep it at the forefront as you work towards building your good credit. We'll provide additional tips and pointers so that you can, again, build your individual or business credit. And I'll also be sharing additional resources for yourself and for your business, social media, books, information that can help you feel comfortable in understanding your personal credit. And the overall goal is to build your credit confidence so that you can feel confident on your financial journey. So let's shift and talk about credit and credit reports. Again, what does credit mean to you? Folks, let's think about that. We'll give it 20 seconds. Credit is a financial opportunity. One can obtain things for personal use or for business use through credit. Services and goods can be obtained via credit. Credit is obtaining something now, but making payments for it later. Let's say, for example, you have an issue on your property and you call a repair person. And let's say it's expensive. And you also have bills to pay at the moment. So you could use credit to pay for those repairs and have them done. And then you move along and make payments to pay that back. So to understand credit, we need to understand that trust is involved. There's a thing called a creditor. This is the entity that is trusting you with that purchasing power and financing you. Credit allows you to have more power to purchase things. With credit history, in comparison to having none, I would say that you're armed, you're ready to go. That's the same thing as having credit history established. You're already a step ahead. If you have no credit history, then your situation where you had that repair and you had to use credit to pay, let's say perhaps you were stuck and had a tough time making those payments and had to make the decision of hurting yourself, hurting your business, or possibly hurting your credit history. So those are some ways it can be impacted. So it's best to have positive credit. Creditors observe whether or not you are worth trusting with their credit. And so that is considered credit worthiness. And based on several factors, they determine how much money will be financed or loaned to you by their credit companies. Key question to consider is, why is credit important? Credit's important because it can come in useful during an emergency. I'm sure you can also imagine, like I just mentioned, some damage to your property and you need to make an immediate repair. So, in those crunch times, credit can be very helpful. Also, another thing to consider is it's easier to use credit than carrying cash. Can you imagine walking down the street with $10,000 in your pocket in case you might need it? That is a ridiculous case. You might even lose some money with having it fall out, versus having a plastic card in your pocket that can be used to charge up to $10,000 worth of purchases. So, with $10,000, you can make a large purchase. You can purchase equipment for business. You can make a down payment for a house. You can buy insurance that you need. And those are all the things that having that purchasing power or that $10,000, that amount of credit would allow you to purchase. Again, that's purchasing power that it gives you. Now, imagine you have no credit. You want to buy something expensive. Let's say, for example, you want to buy top of the line Macintosh. I think they had the new computers come out last week, a week or two ago, and I think their pricing is about $4,000 to $5,000. Let's say you need one for your business, but you don't have the money. What can you do? This is a case where you can use credit. Credit can be used for you to finance the purchase of that laptop. And if it's for a business, then you can use that for your business. Folks can pay you for your services, your business services, and those earnings in turn you use to pay your credit. And so financial power can be significant in your journey. It can help you with housing, equipment, land, office, insurance. More credit means more different types of credit cards, installment loans, equity loans, and so on and so on. Student loans come into play when there's a particular education that you've received and you need to pay off that bill. Maybe you have a semester that was $10,000. Then a student loan would allow you to take that semester and get your degree. That degree provides you a benefit because it allows you to have an improved employment or a better job. That better job allows you to have more earnings, which allows you to pay your creditors easier. So you see that there is a cycle there. Having credit is good at the moment, now, so long as you plan on paying it back in the future or later. Emergency personal loans, you see there, last bullet point on the slide. And what that means is that sometimes we have unexpected situations hit us in life. Maybe we're in an accident and we have to go to the hospital. Maybe we get ill for some reason. And again, we have to go to the hospital and be there for a while. But usually, once you are out of the hospital and you receive your bill, you realize that it can be expensive. And so that's a case where an emergency personal loan would come into play to pay for whatever bills need to be paid in that time frame. Another situation, perhaps, and this is for business, is maybe somebody crashed their car into your office, and maybe you have a wall at your business that's demolished, and you have to pay a handyman to come make those repairs and fix the building. So that would be an emergency personal loan that can be used in that situation. So again, your financial power is significant. So having credit, positive credit, is important. I want to talk about some business credit benefits now. For leases, leasing offices, property, or automobile. Let's say you'd like to make a lease, but the landowner isn't feeling confident. So long as they check your credit history and they see that you've had on time payments, they can feel assured in allowing you to lease the property. Business credit allows you to obtain, again, these leases on offices, automobiles, and a lot of other items. So let's say you own a business and you have your credit history and you can show that you've paid on time. And let's say you have a specific vendor that has allowed you the um, goods that can be used. Let's say it's a restaurant or a cooking business. And let's say they allow you goods to make uh, these products. So you receive these items in bulk, but you have no money to pay for them. Then that's the case where you can obtain a business credit loan so long as your business credit looks good and reflects positive ratings. Then the creditors, the company or the entity who is providing you the goods or the finance, they can provide those goods knowing that you'll pay them back. And once you have the goods, you can create the products that you want to with those goods, sell them for a profit, and make money, be able to pay your creditors and pay yourself as well. So, as we've mentioned all along the series, a positive credit rating is very important. A positive business credit rating is also very important. Purchasing power will allow you to make it through difficult and challenging times. Now, I want to talk a little bit about credit reporting. Let's say you would like to check your credit score, or let's say a lender would like to check your credit score. You may have experienced this already, and you may have noticed there are two types of credit checks. One is called a hard inquiry, and another a soft inquiry. So, generally, how this works, a hard inquiry, if you want to imagine it, it's like, let's just say it's a suitcase being opened up to look inside, right? So, because of that opening, there is a small ding to the credit score, so the credit score drops. Now, a soft inquiry, if you imagine not opening up a suitcase, but just peeking in, that's what that would be. So, a soft inquiry is not a detailed check versus a hard inquiry is. And that hard inquiry is typically made when you are making a heavy ask. So, a soft inquiry is just a light review of your credit score, not an in depth review of your credit history. So, they are a little different. And I'll continue to point out their differences as we move along tonight. Hard inquiry and a soft inquiry. A hard check or a soft check. Let's say, for example, you need to find a new apartment or you need to lease new office space. For that type of movement in life, there usually is a hard inquiry. Uh, Typically, locations want to check your prior experiences at other areas and see what your payment history is there before allowing you to stay on their property. Also, for new credit cards, there is a hard inquiry run. These lenders or creditors want to know your history of payment before they approve you or not. Now, a soft inquiry would be, for example, if I check my own credit report, I want to just review my credit score and see what that's like. If I observe my own credit report, it's not considered a hard inquiry. It's a soft inquiry. And individuals are allowed to, from time to time, check their own credit scores, which I suggest so that you may maintain some peace of mind. Also, for insurance quotes, they run soft inquiries, and they do that to double check and make sure that you pay your bills on time. And so they'll check on your insurance quoted. And also, if you notice, you get pre approval letters quite often. And sometimes those pre approval letters offer an extremely good deal. You're just asking yourself, how? How can I be offered this? Yes, quite certainly, they've done a soft check on your credit history. A lot of people ask me from time to time if a hard inquiry will have an impact on their credit score. And I say, yes, it will. Typically, it's between 8 to 10 points that your credit score will drop. And usually, it will only drop for a maximum of about a year. After that year passes and there is a second year, then that report starts coming off your report. So those points will go down from 6, 5, 4, 3, 2, and then return to your original standing before it dinged your score. And also, let me reiterate, folks, if you have any questions or would like any further details, go ahead and click on the Q&A button. I'll be keeping an eye on that so that I can respond to your questions towards the end of our webinar. So, how do soft inquiries impact your credit score? Well, they don't impact your credit score. Quite often, what will happen is you'll get a soft inquiry, which means will someone look lightly and they'll make an offer of a specific interest rate for a certain amount of money. And if you like that offer and accept that offer, then at that point, that particular lender or entity would do a hard inquiry to verify and double check. And so I recommend to verify any credit checks that are done. Always ask lenders or bankers, creditors, ask them directly. Do you plan on doing a hard inquiry or a soft inquiry? And I'm sure they'll be impressed that you know to ask that because it is their responsibility to inform you of it. They cannot run your credit without your permission. And at the same time, now that you are aware of it, you know if it's a hard inquiry that your credit score might drop, and if it's a soft inquiry, and that it will not. I want to really quickly review some terms that we've covered before. Credit score is a 3-digit number that represents your credit worthiness. And basically that means that the creditor is determining how much they can trust you. That is your credit worthiness. So the offer will depend on how much they trust you. For example, if you have bad credit, they'll give you a bad offer, an offer that you might not like. For example, a high annual percentage rate or high fees, and so on and so on. So keep that in the back of your mind. Check your credit score frequently, once every 2 months or once every 3 months, in order to help you manage your credit better. The next term is credit report. Credit report is a detailed history explaining your personal payment patterns. For example, it will show if you have student loans and you borrowed $10,000 worth, there will be, if you want to consider them little squares or cubes on that credit report, then they could show up green, for example. which will indicate that for a particular month, let's say January, you paid on time, and that'll show. So the credit score will show that history, and it gets in depth, tracking every month of your payment. And the same thing I said just a second ago, I suggest you check your credit score frequently because you have no idea when a lender might want to document that you were late. So that way you can catch that, identify it, and work on it instead of allowing a larger time span to run between you finding out that you have a bad mark on your credit score. And so it's important for you to constantly check your credit score for errors. And if you find errors, have those fixed. Have them fixed and repair for the health of your credit report or credit score. Grace period is another term that we must be familiar with. Once you come into an agreement with your creditor, they provide you a grace period. And a grace period is if, for example, you can't make your payment or you can't make your due date. And let me illustrate this better. Let's say your car payment's $100 due on the 18th. The 15th, excuse me. The 15th comes and you can't afford to make that payment. Now, if even before the 15th, you asked your creditor, they would say, oh, yes, you have a 15-day grace period, which means 15 days after the day your payment was due. And if you can make a payment within the grace period, you won't be reported, or that won't be reported to the credit agencies. So let's say you're on your 14th day and you come in and make your payment. That will help your credit score because it will indicate that you have made your payment on time thanks to that grace period. And again, grace periods and the terms of those are dependent on your creditors. Keep those in mind, but don't get behind on your payments. Please stay within your due dates. Grace periods are really there for when folks experience tough times and really need that grace. Moving on to the next term, utilization. Utilization is another term that is very important to know. It is the amount or the percentage of your available credit that you've already used. So let's say you have a $1,000 credit limit and you spend $700 on whatever it is. That means you have $300 available out of that 1,000, which would indicate that you spent 70% of the credit you were given. Now, 70% is a high number to have spent. And so you are going to make that payment. And let's say you charge a little more, or let's say you make that payment till you're down to having $800 available, right? Let's say another example. You have $1,000 credit. You spend $700, but you pay back $600. So now you have $900 available. And your utilization is down to 10%. Those are good numbers and a good range to be. So we'll get into good utilization percentages on the next slide. Okay, let me ask you folks, what is the ideal credit utilization ratio? And we'll go ahead and give you folks 30 seconds to respond. Okay, the 30 seconds are up. Let's see the responses. Okay, wow, look at the numbers here. No one selected 40%. Everyone went to less than 30%. Good, good. And we see 33% of folks here selected between 25 and 35%. And then we had 67% of the folks choose less than 30%. And yes, that is a correct response. You want to be at less than 30% of your credit allowed spent, which means that at the end of the month, you only want to have used up to 30% of your credit. Now let's shift gears and talk a little bit about building and improving your credit. And I have another poll to ask. In terms of building your trust with creditors, how do you do that? "30 seconds left. Okay, 30 seconds are up. Let me see the responses. Okay, I see a coming in at 75% credit score. And the actual answer is all of the above. So folks, you all chose correctly. All four of these bullet points is how you build trust with your creditors. Now let's review them. Credit worthiness. Are you worth the trust? Can the creditor give you some money and know that you'll pay back what you have? If you have a high credit score, that indicates you will. Your payment history will also reinforce that. And if your credit utilization rate is below 30%, then you're in a good position. Always keep these 4 bullet points in mind. As I've stated along the way, I keep mentioning and reiterating credit worthiness. That is the willingness on creditors and lenders to trust you to pay back that debt. Now, they understand you're not going to return the finance that was lent to you in 1 month, and they understand that there's a term, a length of time for you to make those payments back. The higher credit score you have, that means the higher trust or credit worthiness you have. So you'll be offered better rates without any difficulty. If you have a low credit score, then that means you have a low credit worthiness and you have a low amount of trust from creditors. And so the options to borrow financing will be limited, which indicates that most of the offers you receive won't be good low rates. So you really got to keep your credit worthiness high. It is a priority. Next question. How do I build a credit history when I have no or bad history? Well, you're going to want to start with your personal credit score. Start a business through your own personal credit score. If you've got good ratings and the banks are able to see that, then from there, you can open a business and start working on developing your business credit score. Now, for folks that don't have any credit history, you can use a cosigner. A cosigner is going to be someone that you find that trusts you, that is willing to sign on the debt you borrow. So if you have a cosigner and that cosigner feels that you may not make your payments on time, they might avoid co-signing for you because if you don't make your payments on time, that will affect their credit. And then now I want to talk about emergency loans on the next slide. As mentioned already, the unexpected could happen at any moment, and that incurs a cost. Emergency loans are there for that, for both personal and business. banks offer personal loans. And typically, they offer from $1,000 to $100,000 loans. And you can obtain those funds in less than 7 days. And usually, the interest rate for those can be, depending on your credit worthiness, from 3% to 36%. So they range from high to low or from low to high. Now, there are also credit card cash advances that can be used as an emergency loan. And typically, those credit cards allow you to have a cash advance at an ATM. The only drawback is that typically those cash advances are at a 21% or higher interest rate, and your credit cards tend to have a limit. So let's say you have a credit card that has a $10,000 cash advance limit. You would be able to withdraw that as cash and spend it on your emergency need. Other types of emergency loans are also home equity loans. And again, in both business and personal life, we can have impacts that leave us unable to pay rents or vendors or hardships and difficult times. When that happens, some folks use their home equity to obtain a loan. Now, a home equity loan depends on the value of your house. Let's just say, for easy numbers, it's a $300,000 property. You borrow $300,000 on that property. So on a home equity loan, typically you can borrow bigger amounts than you can on a personal loan or on any credit card offers. Now, I do want to clarify this is not a payday or title loan, and that is not recommended. For you to understand what those are, maybe you've been out in your community and you've seen maybe a small business with dollar signs on it and iron gates and bars. And basically, the way a payday loan works is you offer up your car title in order to borrow some money. You spend that money, and then you've got to return with a payment. And once you pay that money back, you get your title for your vehicle returned. Now, what's adverse about those is, let's say you want to borrow $5,000. So you bring in the title for your vehicle, you borrow $5,000, and typically for these loans, they come at a very high interest rate. So let's say you borrow $5,000, but you need to pay back $10,000. Because of that high interest rate, title or payday loans are not recommendable. Now, tips to avoid getting emergency loans. Well, you can avoid that by building up an emergency fund and budgeting wisely and using a previous loan if you might have one. So instead of having to take out a new loan, maybe via a credit card that you already have, or maybe a loan at a bank that you might already have, ask from one of those and see if you can draw more funds from that. So also, if you experience a situation where you need money, you can also take a loan from family or friends. This slide talks about secured debt, and I'll give you some examples of that. Typically for house and home, and it's based on collateral, which means you agree to offer up, let's say with the bank can put a hold on your vehicle or on your car as long as you pay those items back. Those would be secured by that collateral. So if there's a particular month that you cannot pay it back, the bank does have a right to repossess that vehicle or repossess that house. And I'm sure you've heard of that happening. And so those are typically loans that are done by secured debt, where the banks reduce their risk and it's a good way to start. Unsecured debt are, for example, student loans, gyms at a membership, medical bills, personal loans, and credit cards where there is no collateral involved. For example, with the student loan, you borrow those funds or that money. And is there a way for those offices to hold on to your degree after you obtain it? No, there isn't. So they are trusting you that you're going to be able to pay them back, which is why they have the right to report your credit to those reporting agencies if you do not make your payments back on time, which will in turn affect your credit score and cause it to drop. So do make sure that you are working out with your lenders and your creditors any issues. And so an unsecured debt doesn't have anything backing it, no collateral, making it secure. Therefore, it is typically at a higher interest rate. Now talking about credit unions. Credit unions do have a lot of pros. They are more customer focused, typically charge lower fees, and offer better interest rates. And quite often, credit unions help people with bad credit scores. And keep in mind, if you're trying to make the choice between a bank or a credit score, personally, I would recommend a credit union. Excuse the interpreter, not credit score, credit union. There is also federal aid available, which I want to point out because I do want to leave time for the audience questions. The CARES Act is an umbrella term and houses various different programs within it. Economic impact rebate payments is one of the programs offered. And most people are familiar. Earlier this year, there was $1,200 that was received by most folks due to that rebate payment. Now, if you're someone that does not file taxes, I highly recommend that you reach out to your tax preparer and go ahead and file this year for that reason. Another program was also the PPP program. That program is good for small businesses, sole proprietors, independent contractors, people who are self-employed. And that was where loans were available for businesses that needed them. And it really depended on the amount in your bank and your business's earnings. And there was also a waiver program for the terms and conditions. You'd have to check with the banks that offer those loans. Now, why do I mention these programs and why use these programs? Well, for one, financial freedom. For two, new opportunities. We're in a new normal. Things aren't going to return to the way they were before this pandemic. So we can take those funds or that financing to create new opportunities. Another thing I mentioned also is to pay off any debts. And so to understand these programs completely, you do want to look into their terms and conditions. Folks, you can receive advice from myself. I like to share knowledge, financial awareness, and the more you learn from the workshop series, the more you can continue your self-study and enrichment when it comes to credit confidence in your financial journey. Also, the more you know, the more you can control your financial decisions. Communication is key. If there are any problems with your creditors, you need to communicate with them. Creditors and lenders, they'd be more than happy to work out an agreement with you. Now, these are items or resources recommended by myself for an individual or business use. Changed. Change was also on Shark Tank. And it helps people in paying off their student loans. And you can set it up and sync this app with your bank. And it'll let you know when you have enough money to pay your student debt, your student loan. And it's a simplified approach for individuals on paying their student loan back. Now, on this slide, there's 3 Instagram accounts that I recommend folks follow. Kimberly Hamilton. Following her is good for identifying her spending approach. And Kimberly shares lots of tips on how to avoid high spending habits. So if that hits close to home, go ahead and follow Kimberly Hamilton on Instagram. Kimberly also shares a lot of tips on how to spend your money better. And I just recommend you go ahead and follow Kimberly. My 5 Fab Finance has inspirational quotes, financial quotes, and money management tips. Another good one is Tyler McBroom, who provides tips on how to improve your credit score. Tyler McBroom is also a CPA, fantastic individual. I've followed Tyler for almost 2 years. Tyler has shared tips on write-offs. And so when you don't have a W-2 or you have 1099 income on how to handle that, Tyler McBroom provides a lot of great tips for those types of spending and financial tips during tax time. In general, those 3 accounts are highly recommended by myself to you folks. And also I recommend these books, Grit, Leaders, Rich Dad, Poor Dad. And my favorite out of these 3 is Rich Dad, Poor Dad, I'd have to say. And the reason why it's my favorite is because we see the scenario of 2 lives, a rich father and a poor father, and their spending habits and their finances. So if you would like to have a different perspective in life of both scenarios, right? And so this will also point out, if you want to be rich, how you can get there and stay there. And what it is that there's guides for what to do and what to avoid. We are a management firm. Folk Williams Financial is my firm. So let me know if you need help starting a business. We're here to support you. If you need assistance with filing your taxes, we're here to support you. If you need assistance with business management, we're here to support you in your language, American Sign Language. And so we do have a family culture here. And when you come to our business, you're a part of our family. Next slide, hands-on banking. Thanks to the Wells Fargo Foundation for providing that. It is a finance education tool, which is self-guided. And please give this resource a look. Just a thought to share with you folks tonight. I have not failed. I have just found 1,000 ways that don't work. This means that you need tenacity or persistence. People that don't look at their actions as failures, but as ways that don't work. And they continue to figure out a way that will work. And they continue to move forward in their financial journey. You don't want to become stagnant. You need to try, and it's called trial and error. You've got to look for a way. I myself have gone through that. And this is why I'm successful. And I know that, folks, you can do the same. Now we'll open up the Q&A. Let's see if we can respond to some of the questions from our audience. Okay, let me see the first question there. It says, what category would a car dealership be in? So the question is asking either hard inquiry or soft inquiry at a car dealership, and the response to that is a hard inquiry. They open your credit right up to take a look at it. They sure do. So yeah, you'll have to keep an eye on that. The next question says, after the end of a loan, will my credit score go up? Yes, if you've paid it off, it will increase your credit score. Next question says, what if somebody's credit score is already in the good to excellent range? What's next? Well, there's nothing beyond that. You max out at 850. You can feel content with being at 850. And if you can keep it at 850 and maintain it, that's fantastic. It means that you will have the best of options, the best of offers, and nothing but a plethora of choices at your fingertips. Can a cosigner's bad history affect my credit score or my credit worthiness? The response is yes. This is why I always recommend find a cosigner that has good credit history behind them. That will help your credit score increase quicker, as well as your credit worthiness as also. So make sure you screen your cosigners so you end up with the right person. Next question says, I wonder why often I will see a U-Haul business partner with a title or payday loan company. How are they connected? That's a good question. And I don't know how they're connected, but I guess we've got to put some research into this and figure out why, because that is a good question. Someone indicates that they're not asking a question, just sharing some information about the YNAB. You need a budget. Oh, a good one to follow on Instagram. Yes, I do recommend that one. Thank you for that recommendation out there. Good recommendation. Thank you. Next one says, I notice when you pay your credit bills on time, the credit score still drops points. Why is that? The response is it could be your credit utilization rate. You might have a high amount of your credit used up or something on your credit report. So I would recommend you look into your credit report and see why that's happening. Okay, that last Q&A question is not a question, but it's a comment sharing a couple more accounts. We see at the budget Nista and at the finance bar. Thank you, folks, for sharing those accounts as well. Next slide. We've got about 5 minutes left. Enough time to wrap things up. We're wrapping up, ladies and gentlemen. I am done with my series. We've gone through those 4 dates mentioned on the slide. I want to thank you folks for being a part of the series with me here and allowing me to share my information with you. Stay tuned for another financial workshop series in January, and make sure that you subscribe to the social media channels and subscribe to the emails and stay up to date with the latest information. Thank you for being a part of the series, and thank you for joining us. keep your eyes on your email. You will have an email coming from Lawrence@csd.org soon. And that email will contain a survey. And we accept your tips and feedback on how we can enhance our webinars. Again, I'd like to express my gratitude and thank CSD for inviting me to present, which I have done from the bottom of my heart. Also, let's thank Wells Fargo Foundation for making tonight possible and having tonight happen. And I'd like to thank all the members in the audience for being here tonight and being a part of our conversation. Thank you. Good night.